Hi, everybody. Dan Weisskopf here from the ETF think tank, lead ETF strategist here of the ETF think tank, also co-PM of Block, the largest blockchain fund, and also member of the Title Financial Group. So welcome, everybody, to our happy hour. Look forward to a great discussion, as always, in the tank. Do feel free to, send your questions through the chat or on social media through X. So with that, I'm going to hand off the mic to David, and then David, you can throw it off to Cynthia.
Absolutely. Thanks for joining us, everyone. David Shkansky here, portfolio manager within the Title Financial Group. Have a really good guest on today's show, talking all things macro. We'll jump right into it, and I'll kick it off to Cynthia Murphy.
Hey everyone, Cynthia Murphy, head of research for the ETF think tank. Happy you're joining us. We love our weekly shows, and we have a phenomenal guest today. Andy, why don't you go ahead and introduce yourself? Tell us a little bit about yourself and kickstart our conversation.
Sure. I'm Andy Constan. I've been an investor, trader, involved in markets since 1986 when I started at Solomon Brothers. Spent 18 years there and left as the global head of equity derivatives, trading, sales, and structuring, and started my own hedge funds. Did relative value trading for a number of years before partnership issues split us apart. And I decided after the financial crisis to go in and learn macro. Did that for a number of years at Bridgewater Associates, where I learned systematic macro, and then moved over to Brevin Howard, where I learned discretionary macro, and spun off of Brevin as a research firm called Damp Spring, which is my Twitter handle, and my company's name, Damp Spring Advisors, to provide hedge funds with actionable strategy, macro analysis, so that they can find alpha in markets, help them find alpha in markets. I manage a portfolio based on those ideas that one of my clients implements for me, and I provide that as a service to high net worth investors and some of my Twitter followers who wanted more of a deep relationship with me.
So one of the things you're known for, at least from 2023, was what I call the Fed acronym soup. You did a really good job of breaking down all of these things. I feel like the investment world got comfortable with what QE and QT was, and then the Fed acronym soup hit 2023. So if you could, just to frame, give us a little bit of a background of the QRA, the TGA, the RRP, and how they all fit into the overall macro perspective that we're in right now.
Well, sure, I can try. I think that it all comes down to the central bank's balance sheet. Most of the programs that you described, most of the acronyms you described, are government policy or Fed balance sheet issues. And so, the first thing that we have to know is that during the era of zero interest rates, as the Fed ran out of the ability to stimulate by cutting interest rates, they began buying financial assets, swapping reserves for bonds, which took duration out of the market, forced other investors that were selling the bonds to the Fed to buy equity, to buy corporate bonds, say, for instance. And then the corporate bond buyer was often the seller of those corporate bonds was often the company, who then used the proceeds to buy stocks. And the seller of stocks used the proceeds to buy meme stocks, and the seller of meme stocks used the proceeds to buy crypto. And the seller of crypto bought a Lambo. And so that was what stimulated the quantitative easing, stimulated financial assets. And now this time, post-COVID, we had the seller of the bonds being the U.S. Treasury, and the buyer of the bonds was the Fed. And so the U.S. Treasury sort of stood in the middle of that process, sold the bonds, received the cash, deposited it in people's savings accounts. And that created a significant amount of savings, but it also created a significant amount of ability to consume. And that helped during when there was also supply chain problems, and reopening created a very big inflationary pulse. And so now going down into the mechanics, the Fed's balance sheet, and please interrupt me if this is...
No, please, come on, you're setting the whole conversation here. I think this is very important.
Sure. So you have the assets of the Fed's balance sheet, which are bonds they own and loans they make. The loans they make are to the financial system, banks primarily. And then you have the liability side, which are the things they owe. And they owe hard currency. Any outstanding currency is a liability of the Fed. That means bills and coins and things like that. They also owe bank reserves, which are deposits that our banking system puts at the Fed for them to draw on when they need to to pay off their own obligations, deposits to investors. And then there's also this other account, and I didn't mention the Treasury yet. So when the Treasury issues needs to spend something, they need money in the bank to transfer to someone else. That account is called the Treasury General Account, and that account has both inflows and outflows. The inflows are taxes and proceeds from issuance. The outflows are spending and maturity payments, and spending is this too, but interest that they're paying on those things. But spending,
I like to think of it as like the government savings account, like in last resort, when like everything else fails and there's no more money to spend, that's the last dollars they try to spend.
Right. That's what the TGA is. It's really the checking account, I think. It's really just like, if you're at home, you get income and you have spending. And in the Treasury's case, the income is taxes and the spending is expenditures. And then they also issue debt. And so the TGA varies depending on how much those flows, whether they've been issuing debt, whether they've been reducing debt, whatever it might be.
Yep.
And then the next item on the Fed's balance sheet that's become very important is the Reverse Repo Program. And remember, as I said, all that spending that went into the real economy during COVID, $6 trillion-ish, that was financed by the Fed's purchase of the bonds from the Treasury and then deposited in the financial system. That money conceptually should have gone into spending and savings, but the amount of money that was deposited was in excess of what the banking system was willing to allow to be on deposit. And in fact, regulations expired a year after COVID, right after all this spending, and you'll hear about this lately as well, called the supplementary leverage ratio. That exemption made it very difficult for banks at the time to keep deposits. And so what happens when a bank says, I won't take your deposit? Well, somebody with cash needs to buy something, needs to deposit it. They can't, it's digital cash, so they don't actually have bills. 2, they just need to invest it somewhere. And so they gave it to a money market fund. And the money market fund said, gosh, I'm only allowed to buy government bills. And so they started buying government bills, and that started pressing interest rates down, which was an easing in financial conditions because Treasury bills would fall in yield. And so the government could finance easier at relative interest rates. And that created a problem for the Fed because we're trying to keep interest rates in a very narrow range. So the Fed basically said, we'll take your money. Deposit it at this new program called the RRP. It wasn't really new, but it really began to be used as soon as this exemption ran out. And so the Fed took all that money and put it on its balance sheet, and it grew to about $2.5 trillion, and has come down a lot for a variety of reasons, which I can go into.
Well, more importantly, I think a lot of people believe that like the full drawdown of RRP is like when the markets could turn.
Yeah,
could highlight that specifically. What is it about the drawdown of the RRP that then affects the money markets, and how does that fit into the demystification of, well, we have all this money on the sidelines from the money market? Like, how does that all tie together?
Sure. So as I said, the RRP has been falling quite quickly, and that's number one. The number one reason why that is because of the debt ceiling. During the debt ceiling, the Treasury spent its Treasury General Account, the TGA, down to zero, so close that they almost had to shut the government down. But cooler heads prevailed, and they kicked the can down the road, and the debt showdown was delayed till 2025. So now here's the Treasury with no money, and they have bills to pay. So what do? They go and issue $1 trillion worth of T-bills. Now, remember when I said the RRP is just looking for cash, looking for places to put cash? All of a sudden, the Treasury is issuing $1 trillion of T-bills. Well, the money market fund that's invested in the RRP says, I like T-bills. I'll buy those and redeem my RRP investment. And so that was worth about $750 billion of the RRP drawdown. And it had been drawn down from peak for a while. In addition, every month, quantitative tightening withdraws about 60 billion of treasuries mature and 20 billion of mortgages run off. Both of those things reduce either bank reserves or the RRP mechanically. And so that's what, 720 billion of Treasury QT and another 250. That's $1 trillion of pressure on the RRP. And so that's come down. So here we are with coming into this year, everyone watching this extremely rapid TGA build that drove the RRP down and extrapolating it to zero by, I saw people saying March 31st. And that was the straight line extrapolation from, January. Now, it hasn't done that. And I'll tell you why, but the important thing is what happens when it gets there. And why is it important to begin with? Well, as I said, the RRP is just money sitting there saying, I'm happy to invest in T-bills, private sector repo, or the RRP. By the way, that's all I can invest in. I'm not allowed to invest in anything else. That's all I can invest in. And so but at the same time, it's sort of like money that's really primed for bills issuance. Like it lets the Treasury issue bills without any market impact at all. And so that's an extremely attractive financing to tap. And they tapped it in huge size, $1 trillion in the second half of 2023, because they had run out of money. And so they needed to build it back quickly. So what happens when it goes to zero is all of a sudden, all that money that was just prepared, sitting at the Fed, happy to invest in bills or, importantly, private sector repo, which provides financing for people who want to buy assets. All of a sudden, if it's at zero, the Treasury can adjust and say, well, okay, well, you're not going to take my bills because you're at zero, so why don't you take my bonds? And the RRP says, the money market fund says, we don't have any interest in the bonds. So they have to sell bonds to somebody else, but that somebody else may want to lever the bonds. And if they want to lever the bonds, they need repo. And so then that flows back to the money market fund who says, hey, I'm still out of money. I don't have any repo. I used all my RRP. I have bills. I've got enough repo as it is. I'm out. I got no more juice. And so people said, geez, that means that when the RRP goes to zero, all of a sudden there's not going to be any supply of lending to people who want to buy bonds.
So for those of you out there who are looking for like indicators to look from this show, the RRP drawdown is definitely something you can consider and look at from a liquidity perspective. Can you talk a little bit, let's reset and go, or actually let's just briefly talk a little bit about both the QRA and I'm going to throw in Bitcoin as well. So QRA was something that really affected the markets last year. This is the quarterly refunding announcement that basically states how the federal government is going to fund its deficits and what percent are going to be long-term debt and what percent is going to be short-term debt. And surprise, surprise, the rally last year was the government saying, hey, we're going to kick the can down the road. We're taking short-term debt. We're going to hope that rates are lower in like a year or two, doing exactly what a lot of the corporations are doing. So I know QRA was very much like a signal driver of like a lot of alpha in 2023. It seems to be less so in 2024. One thing that I've seen from like Fed announcements is basically once the Fed stated that the Fed balance sheet might run off a little bit around the 7.5 level, that's actually the turn in Bitcoin. So I'd love for you to comment on that perspective. But like the Fed balance sheets run off at that like $7.5 trillion level, it was like Bitcoin ETF came out, GBTC liquidated, Fed announced $7.5 trillion trail off, Bitcoin started rallying. Obviously, a lot of this is flows from retail as well. But how do you tie in some of these Fed's announcements to potential movements in Bitcoin? And do you think QRA is as useful as it was since lots more people are talking about it now?
Yeah, so I've been following quarterly refunding announcement to try to get an edge on alphas for 30 years. Until recently, it wasn't very important for macro. Now I believe it is fairly important, and it gives you two things. The amount of debt issuance that the government is going to make in the following quarter and the composition. And my view is that starting in very clearly in the first half of 2023, the Treasury, because of the debt ceiling, was going to issue a lot less coupon bonds, a lot less of everything, but particularly coupon bonds as they spent down their Treasury General Account, and then shift to bills as soon as the debt ceiling went off, which would create a huge amount of bill supply, and then finally get back to the business of about 80% of the debt being financed with coupon bonds. And those different changes had an implication to asset prices. Basically, as long as you're not tapping asset markets for risky assets like long-term coupon bonds, which are more risky. They're not risky, they're riskless, but they have more price risk than bills. As long as you're doing that, that puts a headwind on asset prices. And they made a big change in July, which caused asset prices to fall until Halloween, and then they paused their increase in coupon issuance on Halloween, and that began what has become a significant rally in assets ever since, including the riskier assets like crypto. Even gold is benefiting from this significant lack of supply of risky assets. I do think there's still alpha in it, and I do think that we're actually beginning to see some headwinds on certain assets. Bonds have performed bad in 2024 so far, and so will that take stocks down? We'll see, but it certainly, and other riskier assets we'll see, but there's some things still there in terms of the issuance. That's the thing that I focused on. I would say that going back to the RRP briefly, in the next quarter, the Treasury is going to issue negative $350 billion of bills. And negative.
That was going to be my next question, actually. If you could comment on that, and also this 4.5% magical cliff on the 10-year Treasury that everyone thinks is like the disaster mode for equities. Like, how do those two things tie together?
Yeah. So the $350 billion of negative bills issuance means all these money market funds that have been currently buying bills are going to see. Normally, everybody gets to roll. You have a bill, it matures, you roll into the next one. In this case, the maturities are going to be greater than the amount that's offered. So that means bills are going to need to, the person that has a bill who for whatever reason won't pay up to roll is going to have cash, and they're going to need to put it into the RRP. And so even though everyone had extrapolated the RRP going to zero rapidly, with a negative $350 billion of bills in Q2, I would expect it to stabilize and actually begin to rise again. My projection is that the low in the RRP will be around $350 billion, and then it will be substantial in the $400 to $600 billion for the balance of 2024. And so there is no crisis such that the quantitative tightening is going to have to stop or slow, despite the Fed saying in their minutes that they are considering slowing quantitative tightening. There is no reason, if the RRP going to zero was the reason, it's highly unlikely that that will actually occur. Well,
just the sheer size of debt issuance from the Treasury coming this year, starting in Q2, is like, I think that's the going concern, right? We started looking at the people started focusing on like the spreads on issuance days on Treasuries, which obviously I think you probably focused on for quite some time, but the overall thing to it world hasn't until as of late. So
sure, but remember that the RRP investor can only buy bills. They can't buy coupon bonds. They can finance coupon bonds in private sector repo, but they really have very limited abilities to push their somebody to take on repo. So again, I think the RRP lasts a lot longer than people think, and thus QT lasts a lot longer than people think. The implication, which may or may not be right, but the implication is that there's going to be, the private sector is going to have to assume this duration issuance, and we'll have to get a concession to be incented to buy these bonds that get issued. So that's why I think there's still the headwind on bonds, because I think quantitative tightening continues. Now, it won't last forever. They only have $1 trillion away from their absolute target of this thing. And that only should take about a year. So I do think they're going to taper. It's just not going to be anywhere near as soon as people expect.
So, Andy, when I'm hearing a lot of what you're saying, and I'm looking at credit spreads the way they are right now, it concerns me in a huge way, especially in the context of, well, maybe inflation isn't under control. What are your thoughts around that, around those two issues?
Yeah, I mean, so I've been on this higher for longer island for a long period of time, and that is a place where economic growth stays strong, stronger than people expect, that there's no recession, but also that inflation stays above target. And that's actually not a terrible place for equities or credit spreads. It's an awful place for bonds. It's an awful place for short-term bonds because the Fed has to continue to keep rates higher for longer. It's also an awful place for nominal bonds because inflation and growth, which are the things that the bonds are anti, both of those things, do very poorly. But equities and credit spreads do fine because corporations earn nominal dollars, and the nominal GDP is literally what they earn. And so this place has always been better for equities than for bonds, and it continues to be better for equities than bonds. the question is, when will that, then there's what you pay for it. And, I was looking at high yield CDX today, and it's at 325 basis points for 5-year CDX. And that's as tight as it's been in a long, long time. And it's gotten extremely tight very recently. But, you look at equities and you look at equity vol, which is sort of like equity and equity vol is sort of like corporates. And you look at those two things, and they support where credit spreads are too. The equity level is very high, and the equity vol is very low. And that's perfectly consistent with where corporate credit spreads are. Obviously there's sectors that are going to struggle, but broadly speaking, credit spreads are just, in my view, just sticking with equities. And so the question that I don't have any particular, I actually think credit spreads are okay. I don't have any particular negative to think about when an economy is very strong. Inflation is not spiking, but higher than expected. That's actually a pretty good place for corporates to be able to pay back their debt, particularly when interest rates are so low, nominal interest rates are so low. So I think conditions are very easy for anyone who wants to borrow right now. And so the refinancing of any debt is cheap. So, that speaks pretty well for ongoing tight credit spreads. The question will be, when will companies, what do you pay for this type of stuff? We're currently paying, not quite 21 for equity earnings, 21 multiple for equity earnings. That's on the high side. Credit spreads are tight relative to long-term history. They're not that tight, but relative to short-term history, they're tight. And so the question is, what do you pay for this stuff? And I think we're starting to see less value in equities, less value in credit spreads, and that they've priced in some of this very strong NGDP. But the question will be, when will we leave higher for longer island? When will growth and inflation land at target, or will they crash land at something below target? And so far, they just haven't gotten anywhere near landing. And so, I'm caught, I never thought we were anywhere near landing. Everyone's, before me, throughout, the last couple of years, I can't remember how many times I've read we're going to have a recession. That's the crash landing. But
whatever it may be, obviously it's not a Boeing jet, but it's still a very hard plane to land. And I still think the likelihood of just the cycles and ups and downs of our markets is that it will at some point kind of overshoot on the downside and have to find its equilibrium, right? It's unlikely to be just this Jerome Powell might go down in history books if he lands that plane.
Yeah, I've been saying from the beginning that I think a soft landing is extremely unlikely. It just won't kill inflation. But you actually have to see meaningful job demand reduction, which typically happens either through austerity at the government level or job losses. And we just aren't seeing anything that looks like that. And so it's unclear to me.
You did see the unemployment rate at 3.9, right? We saw that ever apparent 0.5% increase from low to current unemployment rates. That means it's the next indicator that means the recession is always down the road, that we'll see if this time is different or not on. But we had that 0.5% move, and that's usually that indicator, isn't that not?
Yeah, there are lots of people that will take whatever economic data that looks weak and say the recession is imminent. I'm still not a believer. You can project anything you want. In plain fact, there's nothing in the markets that are indicating that a recession is being priced. And when it happens, if it happens, if it's 2 years from now, you're going to miss a significant sell-off in bonds. You're going to miss a significant rally in credit spreads and equities. So it's really a struggle for me at least, to get excited by weak job data. We all saw the revisions. Sure, they were big, but jobs are still tight. Demand is still high.
So, Andy, when you're speaking to what sounds to me very sophisticated clientele, what are their concerns around these markets? Because what I'm hearing is things are pretty good right now.
Yeah, I guess when it comes down to it, it's how effective policymakers will be at achieving their goals, and whether they're going to attempt to achieve their goals or relax their goals are probably the biggest things that macro investors are dealing with. So the question is, and it continues to be, the Fed is using its short-term rate lever. It's allowing quantitative tightening to go around in the background. And the fiscal side is continuing to run a deficit, but the deficit is shrinking relative to past deficits. And so there are things that are typical for an economy that the policymakers are trying to slow down. But to me, it's not quite enough, given the easing and how easy it is for anyone to borrow. And until that gets tight enough so that it actually squeezes margins a bit, I don't think the Fed's necessarily going to achieve its goal. Now, there are people that completely disagree with me and think the Fed has overdone it. And that's where I think a lot of the decisions are in markets right now. But when you look at what's actually happening in markets, there is no sense that we're heading to, and we just talked about credit spreads on equity prices and vol. There's no sense that there's any sort of hard landing ahead of us in terms of market pricing.
So a lot of this growth is on the back of artificial intelligence, increased revenue, increased bottom line. There have been lots of talks about like how this gets shared between wages and corporate profits, right? So is this just going to be a reshuffling of work opportunities for people in a seamless fashion where both sides participate equally? Are we teetering towards the corporate side? Some people say, for example, like NVIDIA or in the chip side of it can only be such a small portion of the overall opportunity. I know, it's hard to rationalize so much growth that we've seen in such short time, not having some sort of pullback.
Yeah. So, that's not really my lane in terms of AI. When I think about AI, from a macro standpoint, I'll break it into three things. Firstly, there is significant demand. That demand is for chips, in this case, by and large. And the seller of chips, benefits from that large demand. There's also demand for those who are going to plot, code, build the future of AI. So those people typically have developer, software entrepreneur skills that are being sucked away from traditional things that they did. And so there's a wage demand that's going toward those people. And obviously, people with skills to build AI are going to be the beneficiary. But that spending creates income for these companies, which creates GDP, which creates growth. And the income creates demand for stuff, and that's inflationary. So the short answer is that we're in a phase of robust spending, large demand for a certain sector and set of people, and that generally is an inflationary pulse. The idea is that it will ultimately be deflationary. Now, let's take that next bit, which is deflationary to whom? Well, if you replace a worker with something that can make 10x what that worker did, that should lower the price of that thing a lot. And so when you replace, you get this productivity boost, which lowers prices. Now, I don't know how productive AI will be. I know it's not happening now. It will be productive. It's just not happening now. And so it will be a deflationary pulse to offset this inflationary pulse that we're seeing. But at the same time, somebody loses their job. And that person has no more income. And so how is that person going to be able to spend? Well, the good news is for the aggregate economy, prices are falling. So that's good. But that person has no income. And so that speaks to policy in terms of, what it's like when you have a displaced portion of your workforce. And does government step in or does government not step in? And, that's down the road. And, there's lots of people that are way smarter than me on that. But universal basic income ideas start to come up and things of that nature. But again, I trade markets with a 1 to 6 month horizon, and that's not playing out anytime soon. So the last bit, and this is, I think, the most interesting part about the rally in AI, and you're beginning to start to see it. The way I think of the AI pie, the revenue pie from the opportunity, is it's big. So the U.S. GDP is roughly $25 trillion. Last year, tech spent, I think it was 6% of GDP. It might have just been the big tech companies had 6% of the GDP in revenue. In fact, that's what it was. Mag 7 had 6% of GDP. So most of GDP is, isn't the wallet that AI can take. It's not going to take food. It's not going to take the services we all get every single day. It's not going to take the military. It's got to take a small share. I don't know what it is. But if you just say, okay, it's going to take some share of GDP, it's not going to grow the pie. It's just going to have to take somebody's piece. You use a number like 1%, or, you're talking about $250 billion of, no, it's $25 billion of a 250 billion, sorry, 250 billion of revenue opportunity to take 1% of GDP. So that, I don't know what it is. Maybe it's bigger. Maybe it's 500 billion. But then there's who gets to eat from that pie. And the way I look at it, that pie is oversubscribed by the valuations of companies. That doesn't mean NVIDIA is cheap or rich. It doesn't mean that Google is cheap or rich. It doesn't mean that Microsoft is cheap or rich, or any of the people who are sidling up to get a piece of that pie. But it does mean that in aggregate they're rich, because some guys are not going to get any pie, or everyone's not going to get as much pie. And so when I go through that, it makes me think that you really have to be good at picking the winners here. And, you're starting to see that with the trouble that Google has had dealing with the threat of AI towards search. And so, that's what I think about when I think about the AI growth. But without a doubt, it is a very concentrated impact on stock prices. I recently tweeted out something about the impact of NVIDIA on the S&P return. And over the last, since 2020, Jan 1, 2023, NVIDIA represents 18% of the total price return of the S&P 500, which is, quite a thing to say. That doesn't mean it can't outperform the S&P going forward, but it certainly means that a lot of other stocks are suffering.
It's if I may throw in an anecdote, I spent a lot of time in the Bay Area this year, and I got to tell you, socially in conversations, half of the folks out there, all of them younger than I am, everybody's developing their new AI startup. It is the only thing in dinner conversations. It's so the concept of, AI is overprescribed. It's going to be interesting to see who emerges and who doesn't. But I was going to ask you, a couple of days ago, you tweeted something about you being known as the perma bull who has turned bearish. You sound like the most optimistic bear I've ever heard. So in a storm, I want to be on your ship because obviously you don't panic and things are very calm. Let's talk a little bit about how you navigate this as an investor. So, before the show started, we were talking about passive versus active management, how to really think about where the opportunities are. So talk to us a little bit about how to implement the current macro scenario that you're seeing. Like, do you pack up on equities, as you've been suggesting? Is there such a thing as alpha worth pursuing? Like, walk us through your train of thought.
Yeah, so
be specific.
Yeah, so I think it's very important to recognize what you're trying to do as an investor. And that is that you're trying to earn lifelong wealth through investing. You're not at a casino. You are saving your principal job is your job that generates your income. And you're trying to save you for the future. And the best way to do that I've ever seen is the free money that is offered to investors by just assuming risk. And what I mean by that is that those startups you were talking about are looking for somebody to provide them with money. A homeowner is looking for someone to provide them with a mortgage. All of these things, any asset has what's called a risk premium associated with it. And that is, if as an investor, I'm going to part with my hard-earned cash, I better have a positive expected return on my investment. And over centuries, investors have received an excess return over what they would have had if they had stayed in cash on a risk-adjusted basis. And that means that if you're at home as an investor, your job is very simple. Stay invested all the time in something that is passive and diversified. And so that's what I do with my long-term savings. And what I recommend to anybody I talk to, my children are becoming investors now. Long-term assets, never look at it. Contribute whatever you can save, own diversified beta. And so what is that? I happen to like the sort of approach that I learned at Bridgewater, which is a portfolio that's a bit less heavy equities and a bit more heavy gold or crypto and commodities than most portfolios, because I think there is that we've had 40 years of portfolios that have not had to worry about inflation. And that leaves the 60-40 portfolio is, as we saw in 2022, very exposed to a period of time in which there's, inflation for longer. And so I think that's probably the best way to do it. But there's a million ways to be diversified and have beta. And that brings up the second point, which is it's also really important to do it at low cost in a tax-efficient way. And so if you take anything from this conversation, always invested, always long assets, always long, low-cost, diversified, tax-efficient vehicles. That's the simple answer. Now, at the same time, as a professional investor for most of my career, I also think alpha exists. And alpha is beating the market. It's whether you're a stock picker or a macro investor or anybody else. And what I mean is, like, not just you're long and you're beating the market, but you're long, you're short, you're long, you're short, you're changing your allocation, you're going from one stock to another stock to another stock. You're constantly changing. That changing of the portfolio has to outperform cash. You have to beat the market. You can always, like, as I said, stay invested fully, but then chop to beat the market. That's what we call alpha. And I think it exists, but I think it's also way more difficult than people think. There's this incredible survivor bias in which you hear about people who have alpha, but they may just have flipped coins successfully, and then they were just lucky and on a streak. Alpha is really hard to get. And I try every day. I work constantly trying to improve the way I source my alpha. And I'm competing with major places that are like have way more resources than I do. And so I think it's very hard, but I also invest in alpha. And right now I am bearish assets. There are times when I not only want to be bullish, well, as I said, I'm always long beta, but there are also times when I want to be levered long beta. In fact, most of the time I want to be levered long beta because most of the time assets go up and leverage allows you to make excess return. But right now, that's not where I'm at.
But so you're, like, to your point, I think we talked about this earlier as well. You're benchmarking alpha to cash. So that's how you level set, whether you're actually achieving your goal or not.
Yeah, because my position in alpha is nothing. That's my baseline. And so if my position is 0, that should earn cash. And then I'm either long something or short something. And so assuming that's a 50-50 bet, what I could be long just as often as I could be short, my neutral exposure is cash. So that's why I benchmark it. Now, I could say, well, I'm outperforming the S&P or I'm outperforming my beta portfolio. But that's not the right benchmark. That means that you have beta in your alpha. You have to eliminate you have to say what you're betting on. And that is, if you're market neutral, your benchmark should be cash.
So you're super, as a final thought, so are you super skeptic of all this product development we've seen, to talk specifically about the ETF market, that has been all in active management, all the pursuit of alpha, and we're being also gung-ho about that opportunity set? We're done watching plain beta portfolios come to market. It's all about that active management. Are you super skeptical about that? Is it a little bit of an illusion and we just should stay mindful of the fees?
Well, I think there's a question of what you're replacing. If you're trying to convince an investor to go from passive beta to active beta, that in an ETF wrapper. So they're already in an ETF wrapper and you're going from passive to active. And I'm skeptical. Yes, I'm very skeptical. It's very unlikely that the portfolio manager has alpha. On the other hand, if you're trying to get someone to go from an active mutual fund to an ETF wrapper, in that case, you may be both saving fees and having advantageous tax. And that's a perfectly good reason to get someone in an active ETF wrapper. Not something I'm not skeptical at all, something I think is, great. Now, the question is, can you get that ETF wrapper and not get worse alpha? If you can get equal or better alpha from the investment you're moving from in a tax-efficient, low-cost way, that's a great place to be.
Have you considered, obviously it sounds like in this inflation profile, higher for longer profile that you outline. If you had to choose between stocks and bonds, you'd be leaning towards stocks. But it seems like the thing that could unwind stocks the most is there for the movement and duration within treasuries. What about a hedge where you're essentially looking at the volatility of equities just versus treasuries, and you're just long the VIX and short the move? It feels like that's like the magical hedge here then to kind of sleep at night next to your beta portfolio on the equity side. And can you just confirm your beta portfolio is primarily equities, and then obviously the commodities, Bitcoin and gold is around that, or is it kind of a full risk parity portfolio amongst those asset classes?
It's a full risk parity portfolio. It has less than a 60% allocation to equities. And in fact, my smart beta, which is an active beta, is even lighter now because it has a fairly significant amount of cash. But it's proportionally less than the 60-40 portfolio in equities, and has more bonds. In terms of my instantaneous 1 month outlook, I'm pretty bearish on both stocks and bonds. 1 to 3 month outlook. I don't have a strong favorite, but I could be wrong. And the important thing that when thinking about my short-term view is that both bonds and stocks appear rich to me, and I don't particularly care whether we hard land and I make money on my equity short and lose money on my bond short, or continue to stay elevated and then I make money on my bond short and lose money on my equity short. I don't particularly care which way it plays out. What I don't want to have happen is we soft land, because if we soft land, pretty much I'll lose money on both my equity and bond short.
And for context, in your entire career as an investor, how often have you felt this way, this bearish about everything?
Gosh. Well, I really have only been doing macro for a while, since 2010. And I was bearish, but I wasn't anywhere, and for no particular reason, ahead of 2020 COVID, but not because I knew anything about COVID. I just happened to be bearish and got lucky. And then I guess I was bearish at the end of leading into Jackson Hole in 2022 and leading into the QRA this summer in 2023. But prior to that, it was very hard to be bearish in 2010. From 2010 on, very hard to be bearish. Very easy to be bullish.
So if your high water mark essentially is 4%, call it cash, maybe 3%, 4%, 5%, you must factor that into your decision making in your allocation. So on a net basis, gross long, right? Where do you stand on your cash allocation right now?
Where do I keep cash?
Not where do you keep it? How high or low is your cash allocation in a overall portfolio?
In my beta,
listen, cash is an asset class.
I'm trying to stay on my portfolio.
Yeah, cash is an asset class. We'll agree on that, right?
Yeah.
But I think it's right now in the way of.
Yeah, I think that is best. As I said, cash is my benchmark in terms of returns for my alpha portfolio, but I could be long or short cash at any point in time. What is important is how much cash I hold in my beta portfolio. And right now I have my highest allowable allocation to cash in my active beta portfolio.
So
I was gonna jump to, you can go, David. I was gonna ask about crypto. Is that part of your mix? And if it is, when did you get in?
I don't have any crypto in my investments. I am a newbie don't know anything about crypto. I read a lot about it and pay a lot of attention to it, but it's not really in my lane. However, I think that crypto has, if it were to become digital gold with the ability to transport it more easily than physical gold, it does have a lot of the attributes that I care about for gold and would replace my gold allocation, which is higher than most by a fair amount, higher than most people would normally think to own gold. I would increase that. I would decrease my gold allocation and increase my crypto allocation. But I'm not sure that that's true yet. The beta to what I would call euphoric meme momentum is a little too high for me and not something I understand, frankly. For me to extract it and turn it into digital gold. I really actually liked Bitcoin a lot when it was just like chilling at like in the mid 30s. Like that was great because it was acting like digital gold. It wasn't crazy volatile up to, down to 16,000 and up to, it was a store of value. And at this stage, I wouldn't have any allocation if I knew anything. Well, firstly, I know anything about it. But if I were to know anything about it and looked at the price change, I would say I shouldn't have an allocation because it's not acting like digital gold.
But didn't you say you did have an allocation in the beta portfolio?
No, I said I could. I did not. I have gold.
Okay, got it.
I'm saying gold is a store of value asset. I don't have crypto, but if I were to, it would be in that particular allocation.
Yeah, and in a risk parity sense, then the follow-up question would be, how many times did you actually trim your Bitcoin diligently, which I think a lot of people overlook that. So obviously higher for longer. At some point, interest rates come down. What is a world where interest rates come down in the short term and the ever anticipated relief to the real estate markets in 10 and 30-year rates doesn't occur, right? What's that world look like where short-term rates come down, but actually borrowing rates for corporations and residential real estate doesn't really budge that much? What's the scenario where that comes into play?
Well, that would tell me that the Fed has cut rates because they administer the short rate, and growth and inflation is staying robust. So that's sort of like the thing they fear most is cutting too early, and that keeps long-term rates high, which they're not. They're cutting for a reason. It wouldn't be true if they were cutting and we were heading to a recession. In that case, the long-term rates would have fallen. But if they cut early and rates back up or stay where they are, that means they cut too soon.
Andy, we're at the top of the hour here. Thank you for a fantastic show and teaching us all the acronyms and the Fed soup. And honestly, I think you did a fantastic job describing that. So thank you very much. And to all our listeners, thank you. We will be live again next Thursday at 5 o'clock. Andy, any final words? Do you want to give a shout out to anything you're working on? Please feel free to do it now. And we'll see you guys all next week.
Follow me at either Damp Spring on Twitter or Two Gray Beards with my partner, Nick Giba, and we'll see you on Twitter.
Thank you so much.
Thanks, everybody. Bye.
Bye.